Hello and welcome to the IG Markets online seminar, Profiting from Falling Markets. This is a seminar that we do now and again, and it's just a very brief introduction to short selling. There are still, it would appear, quite a few people out there who struggle with the idea of how to profit from a market that's sliding. So this is just a quick run through how to do that, trading using CFDs. If you're watching the recorded version of this seminar, it was held live on Thursday, December the 3rd at 2:30 in the afternoon. If you have a look on our website, igmarkets.co.uk, you'll see the education section there. Click on there and it shows you, go to online seminars, it shows you what online seminars we have coming up. So there are 3 coming up after this one on Forex, one on managing risk, and one on level 2 trading. But every seminar that we do gets recorded as we go along. So if you want to find out more about trading with charts or an intro to CFDs, you can click on here and watch those seminars at your leisure. Okay, and that's all direct from the IG Markets website. But today we are doing the short selling one. So let's get back to the presentation quickly. Before we start, we'll just do the risk warning. It's important to remember that CFDs are a leveraged product and can result in losses that exceed your initial deposit. CFDs may not be suitable for everybody, so please ensure that you fully understand the risks involved. IG Markets provide an execution-only service. This presentation does not contain and should not be construed as containing an investment advice or a recommendation or an offer of or solicitation for a transaction in any financial instrument. IG Markets accepts no responsibility for any use that may be made of these comments and for any consequences that result. Okay, let's get on to it. So what is short selling? The simple way of explaining it, it's a way to profit if you think a market is going to drop in price. So it's a way to position yourself to profit if you feel a market, whatever that market is, a share like Marks & Spencer's, an index like the FTSE, a commodity like oil, is going to fall. And the mechanics of short selling are incredibly straightforward. You sell first because you expect to be able to buy back later at a lower price and book a profit. And this idea of selling first will have some people tying their brains into knots, thinking, well, how can I sell something I don't own? Because that is what you're doing it. I think the easiest way is just to accept that you can in financial markets and don't worry about it. But let's walk through an example. Let's assume you think the FTSE 100 is due a slide, and let's say it's currently trading at 5,000. So you've got no open position on the FTSE, so you have no trades open, and you think it's going to drop, so you want to sell short. So the first trade you do to open up the position, you sell at, for example, 5,000. 3 hours later, if the market is at 4,950, you're 50 points in profit on the trade. It's dropped as you expected. Of course, conversely, if it's at 5,050, if it's gone up 50 points since you sold short, you're making a loss in the position. You can close the trade whenever you want to. So again, you can just be in for a few seconds, or you can stay in for days, weeks, and months. Exactly the same as if you were buying something. It's completely up to you. And of course, the way you'd close the trade, if you sold first, then you would close the position by buying back to close the trade out. With short selling, it's important to understand the different risk-reward profile versus going long. If you're short, your maximum profit is if the market in question falls to zero, which for most markets is something of a theoretical level. You know, if you went short the FTSE at 5,000, your maximum profit is going to be 5,000 points if the FTSE should fall to zero. I think if the FTSE falls to zero, we've all got bigger things to worry about than how much money we've made short selling. But that's your maximum profit. So you have your profit is limited, but your risk is theoretically unlimited because the market that you're short of could continue to rise forever. If you're short the FTSE from 5,000, in theory, of course, the FTSE could go to infinity. So you could have unlimited losses. In reality, of course, that doesn't happen. But there are ways to manage that risk. In the same way when you're buying, you can use stop losses. You can use stop losses in exactly the same way when short selling. So you would set, so if you sold the FTSE at 5,000, going with our example, we'll do some real trades in a minute, but if you sold the FTSE at 5,000 and you want to put a stop loss in place, obviously your stop loss goes above where the market is trading now, because you're going to throw in the towel on the trade if the market rises. So it's a way of limiting your losses. Your stop losses go on the upside. And that's it. That is short selling. Let's do it then. Rather than talking about it, let's get on and do something. Let's do the FTSE 100. So I'm going to bring up the chart for the FTSE. And again, the software that I use for this is our trading platform, Pure Deal. This is from Pure Deal. So this is something you can have access to if you're a client of IG Markets. So this is the FTSE today. We're seeing a bit of a quiet day, I think, today. What's the change on the FTSE? Up about, where is it? Up 18 points so far on the day. So let's say we were getting a bit bearish on the FTSE up here because we've seen it since 11:30 this morning run out of steam in this 53.50 area. So we think, okay, up here the FTSE is going to slide. So we want to try and profit from the FTSE dropping. So let's bring up our dealing ticket for the FTSE. There we go. We'll do one contract because we're trading CFDs. We can put a stop loss on at this point if we want to. I'm not going to. We'll put a stop loss on when we put the trade on. But we think the market is going to go down from here. So if we think the market's going to go down, we are, of course, not going to buy, because if we think it's going to go down, we're going to lose money if we're buying. So what we do to open up the trade, we sell. There we go. That's it. It's done. We are now short the FTSE. It is as uncomplicated as that. So there's our FTSE 100 trade. It shows -1. Let me just tidy up these columns so we can see all the information. Let's bring that across. So -1 FTSE. So we went short from 53.43.8. The market's currently there, which of course we'll update in real time. So if we got out to the moment, it's moved a couple of points against us. And on this contract I've traded, on the CFD contract, a 1 point move in the FTSE is a £10 move from a profit or loss point of view. On contracts for difference, we also have mini FTSE 100 contracts where a 1 point move is a £2 move in value. So you can trade the mini contracts if you want to. I've done the full size contract here. Here we go. So we're short, £1 a point from there. The market is ticked a little bit lower now, so you can see we're in profit on that trade. But of course, we want to try and manage the risk. So I did this trade thinking that we're going to see this level. Let's just draw out a quick line on there. This level proving to be something of a barrier. Of course, this is a very short-term chart we're looking at here. It's just what's been going on today. But that's the level. So let's say we're quite happy to stay in the trade, but if the market gets to here, 53.57, we would like to come out for a manageable loss. So again, I can put my stop loss in. If I click on stop, click in there. So I said 53.57 is the level, 53.57. Click on submit, and that's it. My stop loss is in. So of course, that's gone in above where the market is trading, because I'm willing to have some movement against me, but if the market gets as high as 53.57, I want to come out of the trade with a manageable loss. Okay, so short selling is really as straightforward as that. Let's have a look at another market. Let's what should we do? Let's do crude oil. Actually, no, I'll tell you what we will do. Let's do gold. Let's do gold. So we'll bring up the chart for gold. Of course, as I'm sure you all know, gold towards the end of 2009 has been having quite a run. As you can see there, that's gold going back to early September 2009. But you can see the move really after it broke out in October to fresh highs. It sold off a little bit, and then it has been going like an absolute train all the way through November. The price of gold is already up, what's that, about $170 on the month so far, so like a 16% rise for gold just in November. So a cracking rise there. But let's say we were of the opinion that gold, there was a risk of a sell-off in gold. So let's say we quite fancied being short gold, but only if it breaks below this level here. So yesterday afternoon, we saw gold drifted back to around about 12.06 an ounce before springboarding up another $20 overnight. And now it's currently bubbling around 12.13. But let's say we thought, well, if gold breaks below that low, we reckon it's going to sell off a fair bit more, for example. Not that I do think that, but let's say that's our view. We think if we break below 12.06, this market is going to drop. So we've got a couple of choices, but we don't want to put the trade on now, but we've got a couple of choices. We can either sit here watching gold, ready to pounce if it breaks below 1206, but gold is a 24-hour market, so we could have quite a wait. An easier thing to do if you want to get short gold through that level is set up an order to open the trade. So let's do that. So we use drop-down list, order to open. So what we want to do is sell gold. The level I'm going to pick, I think 1206 was that support. So let's say if gold gets to here, 1205, we want to be short gold. So we go 1205, we'll put our stop loss in. How many contracts? We'll do one contract. So the system knows it's a stop order. We are selling on stop. It's not a stop loss, it's a stop to open up the trade. But we don't have to worry about that because the system works all that out for you. We can choose to have this order good till cancelled, which means it stays in until it gets hit, or we choose to cancel it, or good till a specific date and time. Let's say I only want it effective until the close of business on the 4th of December. I can set that up. What I can also do, I can also put in what's known as a contingent order, that if the market drops below that level and I get filled, then I would like to have a stop loss on the trade. So if I say, right, if I get filled down here, please put a stop loss 20 points away. So what it's doing now is I'm going to go short at 1205 if it gets there. If that trade gets filled, it will put a stop loss on the trade 20 points away from where I'm short. So it's estimating if I get filled at 1205, my stop loss goes in at 1225. And that's it. So I click on submit. So of course it doesn't change my open positions window. So my open positions remains the same. It's my FTSE trade there. But if I go to working orders, you can see the order I just placed on gold. So there's my order on gold waiting to happen. So at the moment I'm not short gold, but my order's in at 1205. And that's where the market is currently, 1213. If I change my mind, I can edit the order from here. I can change the level. Or I can just delete the order altogether if I have completely changed my mind in it. And that's it. That is short selling. Let's say we wanted to close this position now. Let's say we've changed our mind on the FTSE. So we're losing at the moment about £55 on the FTSE, £60. We think, oh, actually, that wasn't a very good decision. I would like to come out of the trade. The easiest way of doing it, clicking on the market in the open positions window. And of course, because we sold to open up the position, to close the position off, we just need to buy back. Okay, so we're going to click on that, buy back the position, and that's it. It's done. So the trade has been done. So we came out of that for a small loss. Let's have a look at that. There we go. There's the trade, 53.43. We came out at 53 and a bit, so we lost £97 on that trade. Okay, so because we sold at one level and ended up buying it back a bit higher. Of course, to make a profit, we want to be buying it back a little bit lower, hopefully. But short selling really is as easy as that. It's one of these things that you really shouldn't have to tie yourself up in knots with. All the markets we quote can be traded in both directions, whether it's shares or currencies or commodities or indices. Of course, we had the ban last year on financial stocks. Various exchanges around the world, including the UK, introduced a ban on short selling financial stocks to try and introduce some stability into markets. And whenever those sort of bans are in place, we do mirror them as well. So you couldn't go short the banking stocks with us when the ban was on. But those bans were lifted earlier this year. So all markets now can be traded in both directions. And it really is as straightforward as that. It's the same as clicking buy or sell. Clicking buy to open a position, but it's buying and selling in reverse. You sell first and buy back later. So you shouldn't be afraid of short selling. If you have a negative view on a market, it will let you profit if you think that market is going to fall. Okay, and that's it for the recording. This is where we wrap things up. But if you have any questions after watching the recording, feel free, drop me an email, david.jones@igindex.co.uk. Have a look on the website for the other seminars that we do, and you can open up a demo account if you want to try out our platform from igmarkets.co.uk. You can register for a demonstration, or if you want to just open a proper account, again, this can all be done direct from the website.